Hello everyone. In this learning objectives, we will be discussing various methods of equity valuation. So there are basically a range of different approaches of equity valuation that are adopted by investors, and we will be discussing them in this learning objective. The idea of fundamental analysis as investment strategy is to get a measure of intrinsic value and compare that to the share price. We look at the intrinsic value of the firm by assessing its current and future profitability, as discussed in the previous learning objectives. Often, that profitability will be examined using a top down approach where we consider both macroeconomic and industry influences to get an assessment as to what the future profits of the firm should be. So the purpose of fundamental analysis is to identify mispriced stocks relative to some measure of true value. The key question or key challenge is to ask how to come up with the true value measure. Now, there are many investors who would argue that this approach to investing doesn't have merit, although we have to be a little bit cautious when we warn against this sort of valuation. As an example of is Henry Blodgett, a Merrill Lynch equity research analyst in January 2000, stated that valuation is often not a helpful tool in determining when to sell hypergrowth stocks. He was making this statement about a company called Internet Capital Group. And this statement was made right in the middle of the dot-com bubble. During the dot-com bubble, according to many different models of valuations, these internet companies were overvalued, but many investors argued that this conclusion about overvaluation of internet companies was just a flaw with the valuation models that weren't able to accurately capture the growth prospects of firms. Well, interestingly, at that time, Henry made this statement. Internet Capital Group was trading at a market cap of $174 million. 1 year later, the market cap of the company was just $3 million. So this is an example that maybe there was some merit in valuation. There has always been some investors in financial markets who have argued that market prices are determined solely by perceptions or by supply and demand factors that are based on the beliefs and perceptions of investors or potentially the biases of investors. Now, while perceptions matter, they can't be the only matter, and what we should find in a relatively efficient market that firms' fundamentals are the key determinant of prices, and if there are any mispricing. We might be able to try to get a better model of those fundamentals to identify what the true value of a stock should be. So it's important when we think about valuation is that we start with identifying some misconceptions about valuation process. First misconception is that valuation is an objective search for true value. It's important to note that all valuations are biased to some extent. The only questions are by how much they are biased and in what direction. So the magnitude and direction of your bias is directly proportional to the profit you can generate on that investment strategy. What we are trying to do in terms of valuation is not necessarily find a true price, but find a less biased estimates of true price. The second misconception is that a good valuation model provides a precise estimate of value. It's important to note that there is no precise valuations. For this reason, often we find that a lot of analysts won't actually give a point estimate of value, but they will give a valuation range as to the range the analysts think the share would be valued between. So the value or the payoff of the valuation process is often greatest when valuation is least precise, because in this circumstance you will have a lot of conflicting views as to what the firm is actually worth. And if you can be the most accurate, you can profit the greatest from it, even in these circumstances. You are never going to get an exact measure of valuation, so just coming up with an ending key range is often more useful. The third myth is arguably the most important one. There is a myth that the more quantitative the model, more factors included in valuation process, the better the valuation is. But what's important is that the understanding of valuation model is probably as important as the output itself. A complex model is difficult to understand because of so many inputs. For this reason, often simple valuation model do better than much more than complex ones. For that reason, with respect to valuation, we often acquire the principle of parsimony. This principle states that we should try to acquire the simplest model we can get away with. We should not add unnecessary input simply because it adds complexity to the model. Well, we want a reliable model, so it should not be too simple. We also don't want that's going to be overly complex. So keeping this in mind, what are some approaches that can be used for valuation? Well, there are a range of valuation approaches. The first one is the discounted cash flow valuation. These approaches based on the principle that the price of an asset should be the present value of the future cash flows to be generated by that asset. There are two different approaches to discounted cash flow valuation. They differ in terms of what the expected future cash flow is going to be. In one instance, we assume that the best measure of the expected future cash flow to investor is dividends that are expected to be paid by the firm. The dividend discount model measures the current value of firm as the present value of future dividend payment. Another model is a free cash flow model. Well, the free cash flow model measures the value of a firm is the present value of future free cash flows. So free cash flow is the difference between the cash flow from operation and the cash investment. So it can be quite difficult to get an expected future dividend or net cash flow forecast. So we might look for a more secure method of valuing a firm, for example, relative valuation method. Relative valuation enables you to make an estimation of the value of an asset by looking at the price of some comparable asset with similar features. Relative valuation is quite commonly used in the real estate industry. We know that when a real estate agent estimates what a property's worth is, they will consider prices of similar properties from the same area that they have sold for in the past. Same thing can be applied in terms of valuing stocks. Let's say we want to value stock A. We can look at stocks that have similar characteristics to A in terms of things like earnings, cash flows, book value, or sales. And based on those estimates, what we do is we calculate some ratios, for example, the market to book value ratio or price earning ratio. Then using these ratios and the earnings, cash flows, book value numbers of firm A, we will be calculating the values of firm A. Just going to slightly more detail in terms of the dividend discount model we said before, we know that we can use it only for those firms that pay a regular dividend. So this model doesn't work if we have got, for example, a non-dividend paying stock. So one requirement is that it's useful for regular dividends, and also we want those regular dividends to be an amount that is close to the free cash flow to equity. Dividend discount model is also useful for firms where free cash flows are quite difficult to estimate. A good example here are banks and financial services companies. For these companies, future forecasts of free cash flows are hard to come up with. So dividend discount model tends to be the best approach. The free cash flow model is used for firms that pay dividends that are significantly different from free cash flows. So if you had a non-dividend paying stock, or perhaps a stock that paid a total cash dividend that was either less than 80% or greater than 110% of free cash flows, you might use a free cash flow model because free cash flows are a better measure of expected future cash flows of the company in that circumstance. Free cash flow model is also widely used for firms where it did not have dividends, for example, private companies or initial public offerings. In these circumstances, we don't have a historical time series of dividend data that we can use in our valuation approach. So that's the end of this learning objective discussion. Thank you.